All right, let's jump right in. You can think of a company almost like a person. It might look perfectly healthy from the outside, but to really understand what's going on, you got to check its vital signs. So today, we're going to open up the investigative toolkit you need to give any company a full financial health check. We're going past the headlines to find out what's really happening.
So, imagine this. You see a headline that a company's revenue is just through the roof, and your first thought is probably, wow, this is a winner. I got to get in on this, right? But maybe pump the brakes for a second. Soaring sales can sometimes be hiding some pretty serious problems under the hood. It's kind of like a marathon runner sprinting the first mile. Looks amazing, but can they keep it up?
And to find that real story, you absolutely need the right set of tools. In the world of finance, we call these tools financial ratios. Think of them like a doctor's stethoscope or an X-ray. They let you see past all the surface-level noise and really understand the true health of a business. So let's open up that toolkit.
Now, the very first, most fundamental question any investor or analyst is going to ask is a simple one. Is this company actually making money from what it does every day? It all comes down to profitability.
Our first tool for this job is the operating margin, and it's a really beautiful metric in its simplicity. What it tells you is, for every single dollar a company makes in sales, how much of that is actual profit from its main business, its bread and butter, before you take out things like interest and taxes. It just cuts right through the noise to the core of the business.
Let's walk through a quick example here. Say a company has $2 million in revenue. You subtract the cost of actually making their product, that's the cost of goods sold, or COGS, and then you take out their general administrative expenses. What you're left with is $800,000 in operating earnings. You divide that by the total revenue, and boom, you've got an operating margin of 40%. It's that straightforward.
Okay, so here's the most important part. We have our number, 40%. But what does that actually mean? Is that amazing? Is it awful? Well, by itself, that number is basically meaningless.
And this is exactly why. Context is everything. A 40% operating margin for a software company? That's fantastic, right? At the top of the food chain. But if a grocery store, a business that runs on razor-thin margins, reported a 40% margin, you'd be looking for a typo in the report. The number only tells a story when you compare it to others in the same industry.
All right, so the company's making a nice profit on each sale. That's great, but that's only half the story. The next huge question you have to ask is, how efficiently is it using all of its money, its capital, to actually generate those profits?
And for this, we pull out our second tool, Return on Capital Employed, or ROCE for short. Now, this is a real powerhouse of a ratio because it looks at the entire pool of money the company is working with. Doesn't matter if it came from shareholders or from the bank. It answers the question, how good is this company at turning money into more money?
What's so cool about ROCE is that a company can be great at it in two totally different ways. First, they can just be super profitable on every sale, that's the operating margin we just covered, or second, they can be crazy efficient, just churning through their assets to make sales over and over again. That's capital turnover. Think about it. A luxury jeweler might have a massive profit margin, but only sell a few pieces a month. A discount grocery store has tiny margins, but sells everything in the store every couple of weeks. Both can be amazing businesses with a great ROCE.
And just like before, what's a good ROCE totally depends on the industry. The average for the whole market is around 17–18%. Software companies are incredible at nearly 50%. But look at tobacco, a staggering 62%. Why? Well, it's a business that's very profitable and doesn't need to build giant new factories all the time to keep making sales. Again, context is king.
So we've looked at how profitable the company is and how efficient it is with all its money. But if you're an owner of the stock, you've got a much more personal question. What's the return I'm getting on my money?
And for that, we look at our third tool, Return on Equity, or ROE. This one cuts right to the chase for shareholders. It answers one simple, critical question. For every dollar that we, the owners, have invested in this company, how many cents of pure profit is it generating for us each year? It is the ultimate shareholder report card.
And here's how it works. In this example, the company made a final profit, that's net income, after everything is paid, of $200,000. And the total amount that shareholders have invested, their equity, is $1 million. Do the math and you get an ROE of 20%. That means for every single dollar of equity, the company is kicking back 20 cents of profit to its owners.
So let's be crystal clear on the difference between ROCE and ROE, because it's super important.
ROCE is looking at the return on all the capital in the business, debt and equity combined. It's a grade on how well the company operates. ROE, on the other hand, zooms in on what's left over for just the owners. It's a grade on how profitable the company is for shareholders.
And this is where it gets really interesting. How can a company's return for its owners be different from its overall return? Well, the bridge between ROCE and ROE, as you see here, is something called financial leverage. That's just a fancy term for using debt, borrowed money, to juice the returns for shareholders. Just think, if you can borrow money at 5% interest and use that money to earn a 15% return in your business, that extra 10% goes straight to the shareholders, boosting their return on equity.
Now, our three tools, operating margin, ROCE, and ROE, give us a really powerful picture of a company's health. But the professionals, the big credit rating agencies, they take these numbers and put them into a much bigger framework that includes one more crucial element: risk.
Take a look at this framework from CRISIL, a major ratings agency. It shows this perfectly. The financial ratios we've been talking about, they all fall under this one category, financial risk. But look what else they analyze. Business risk, like how strong the company is in its industry, and management risk, how good are the people running the show. It's a total 360-degree view, and our financial toolkit is just one important piece of that puzzle.
And even inside that one financial risk box, they go deep. Here are 8 of their key parameters. You'll see some familiar faces, like profitability and return on capital employed. But they also look at things like the interest coverage ratio, which basically asks if the company makes enough money to easily pay the interest on its loans, and the current ratio, which checks if it can pay its short-term bills. It's a whole dashboard, not just one gauge.
So, let me throw a curveball at you that the pros deal with all the time. A founder lends $1 million of their own money to their company. When you're analyzing the books, do you treat that as debt, like a bank loan? Or is it really more like an investment, which is equity? This is where financial analysis becomes more of an art than a science.
And the pro answer is, well, it depends. They don't just look at what it's called. They look at how the money behaves. For instance, is the loan subordinated, meaning the banks get their money back first if things go south? Does the founder have a history of leaving the money in the business when times get tough? Can the company delay interest payments if it needs to? If that loan acts like equity, then the pros are going to treat it like equity. It's about substance over form.
Okay, so we have cracked open the toolkit, we've looked at the tools, and we've seen how they work. Let's bring this all together and land on what is maybe the single most important lesson of this entire explainer.
And it's this. A single number doesn't tell you much of anything. A financial ratio all by itself is just noise. The real magic, the true value, only happens when you start comparing. You compare the company to how it did last year, and even more importantly, you compare it to its competitors and to the industry average. See, ratios don't really give you answers, they help you ask much, much better questions.
So you now have the foundational toolkit to look past those flashy headlines and do your own financial health check. You know how to check for profitability, for efficiency, and for shareholder returns. So the only question left is, the next time you look at a company, what story are the numbers going to tell you?